briefly, my background, guys. Hi, I'm a serial tech entrepreneur. I've built a couple of tech companies. One of them partially exited as well. And I've spent more than 10, 12 years in Indian startup ecosystem. Prior to that, I was in capital markets. So I've seen the listed company space fairly closely through investment banks in European markets primarily. I was based in London with Lehman Brothers and some other banks. I've been investing in startups since 2014-15 and fairly active in Super Morpheus since its rebirth, reincarnation in 2020 or so. And so that's my background. And I have some views on the space, the funding space, the business space, as well as where the macro level market economy and the economics that play behind all these actions and reactions are. So I'll share very shortly. Firstly, before we get into the current situation of the market and potential VC slowdown and other implications that they have on the startups and the other early round investors like us, I would like to maybe take a few minutes talking about how the VC ecosystem is, why it matters, why it exists, what are the goods and bads in some sense. Very briefly share that, just so it brings a perspective, because I think there are a lot of myths associated with the funding space in startups and especially the VCs and all. So I would like to try and share some points which may not be that intuitive or obvious to everyone, because they're not usually covered in the media stories as much as many other things are. So I'll just quickly share a bunch of things I want to talk about. So firstly, the role of, so any company in the world has two kinds of funding. They can take equity funding or they can take debt funding. Generally at early stage, nobody wants to take risk with the company. So nobody gives equity funding easily. That's where the venture capital firms came in. A few decades ago, some people started this practice of early stage backing good founders, good potential businesses. And that's what became the VC and the startup ecosystem. That's when the businesses started calling themselves that could scale very fast or that could become very large businesses in a few years or few decades. They started calling themselves as startups. So that happened a few decades ago. In India, this is fairly recent phenomena. I think, if I may say this, generally since 2008-9 is when Flipkart, etc. started getting funded. Maybe the earliest Indian companies that were funded in true VC sense, as far as I know and remember, are maybe 2001, 2002 InMobi kind of companies, which raised from VCs in US, not in India. That's sad, but essentially, I think way to look at VC funding is the following. There is a way one can build a business, that is that you just bootstrap it. You deploy some initial capital, try to make money from the operations, and then reinvest the profits you make and scale the business, right? That's one way in which Zerodha, Zoho, bunch of many other B2B SaaS companies have done well. Some companies have done fairly well, including in the last decade as well. That's a typical bootstrapping model. But essentially, VC funding helps you do things. One of the things it helps you do is do things very fast. So instead of taking maybe 5 years or 10 years to build a market or build a product or figure out the product market fit, you try and do it in 1, 2, 3 years or so. So it's almost like, as an analogy, say if you were to go from Chandigarh to Delhi or Bombay to Pune through the highway, normal speeds would be 70 kilometers per hour, I guess, but VCs would, fund you to go much faster, in which, of course, if you reach there, you'd be much bigger and faster, but you could also lose out. The risks apply, the usual risks apply. There's a typical saying in the VC funding world that, you unfortunately, that you cannot put 9 mothers together and say, give me a baby in a month. Some things take their own due course, due time. Guess what I'm trying to say? Some of the points that are going to follow from here are a little of the dark sides of VC funding, which is not the only scenario and which is not the only side of the coin, but that's the one which gets covered less. So I'm willing to briefly talk about it and then talk about its impact as well on the current scenario. So one is that they tend to push you faster to move towards the next round of funding, next round of customers, without necessarily focusing on sustainability, profitability, competitive landscape and markets, etc. So that's just one thing. And what's important to understand is that capital alone, coming from a VC, if you can raise a lot of money, and many companies have done it, some have done it successfully and exited as well. Many have gotten stuck in between and have just shut down and lost lots of money. Capital alone is never enough to build a business. We must understand this. We must take this in perspective. VC funding is not a sign of success. And if VCs could constantly keep funding, they also need some exits at some points, which could be an IPO, a strategic exit to Microsoft or Walmart or some company or the other. If they don't get it, many companies get stuck in between if they are on unsustainable paths. If the money was alone enough, just one point I want to highlight, think about this. Fortune 500 companies, take Apple as an example, Infosys as an example in India. Apple sits on $200 billion of cash till date. Infosys in India sits on $5 to $10 billion of cash. If they could all just deploy money into startups and make money, they would all do it, right? But they don't. Because what you need to build a business, it's not just money. You need the dedicated, passionate teams, entrepreneurs that can build businesses at an acceptable pace, which the market needs, the products that the markets need. You can't just build things out of thin air. They continue for a while. There are lots of hype cycles we've seen in the past. Wouldn't want to name too many, but if needed, we can get into those. So just remember, capital alone is not what keeps a business going. It has to be at a time, at a price point, with a dedicated teams, with a dedicated patience and perseverance and many other things. So that's important from a startup perspective to understand that funding is not a sign of success, and funding alone will never meet the targets. As a stat, I read it somewhere, I can't remember where, but 70 to 80% companies that get Series A funding, which is a typical benchmark in VC funding, $3 to $5 million to $10 million today. Typically, 70-80% of companies that get that funding never get the subsequent round, and many of them don't even survive the next 3 to 5 years. So just that business has to eventually work. Some funding is helpful. A lot of funding can actually be more unhelpful than helpful. Okay, so that's one thing I want to highlight. Other thing is, of course, VCs would want constantly the next round to happen as fast as possible in a year or two, not later than that. There is a concept of, as we say in India in Hindi, the Nai Dulan, the new startup has a shelf life. If you don't raise the next round in 1 to 3 years, it's not going to happen. And when things don't go well, that's when you really figure out the VC partner. Having VC funding in some sense from a startup entrepreneur's perspective is like marrying into a rich family and living with your mother-in-law. I hope you can at least get the pun here. The funding brings lots of challenges in partnership from wherever you take it. Banks have their own way of working, VCs have their own way, and many times things don't work out. Then founders struggle, and we've seen some examples which are public. Think about Zilingo, BharatPe, many others, and there are some which are not public, which might be close community inside circles we can we may or may not be aware of. But funding is not the only thing. That's what I'm trying to mention. And having a real business model where unit economics work, which could be bootstrapped if needed, is actually the name of the game, I think. And that's what would be one of the things I'll try to mention, what's the outcome of this current sort of funding winter that's going on. Little bit of background, I hope it makes sense. I was just rambling. I was not really necessarily structured, but I tried to cover a few points there. Now let's look at the VC scenario and the funding scenario right now. There are times in the economy when capital is cheap. 2002 to 2006, US had zero interest rates. Capital was really cheap. In 1980s and 90s, Japan, capital interest rates were low or negative, zero or negative, very cheap capital. In such cases, many businesses are built assuming low cost of capital, that they get this capital without too much cost to it attached to it. But when the interest rates start rising, that's when, by then, if a business is not truly profitable and unit economics wise able to fund the cost of capital, then the businesses break. And this typically happens fairly often right now. Also, if one of the things that's changing is the US interest rate that's leading the funding winter. Before we get into 2022, let's look at 2020 and 21. Couple of big things happened. One is COVID happened. Of course, due to COVID, a lot of things got digitized. The digital adoption of many things in the world, instead of taking 5 to 10 years in slow pace, ended up happening in a year or two, right? So that was a big acceleration that happened. One trend we are all aware of. Second trend, very few of us necessarily understand or appreciate, is the reason every asset on the planet got expensive in the last 1-2 years, every asset price went up, was because of excess liquidity in the system. US had printed close to $10 trillion, roughly speaking. That money came into the system chasing limited assets that were out there. So think about 2020 and 21, stock markets, cryptos, real estate, startups. All this money went into them, and hence there were all the news of cryptos going up, real estate going up, stock markets going up, etc. But now what has started to happen is, few months ago, one thing happens with the printing of money, access liquidity, is that the inflation goes up too. The price of the day-to-day goods go up, and then that impacts the rest 90% of the economy, which is not necessarily into startups or into stock markets or into cryptos. So those people, when they start getting impacted, the governments have to act and start raising the interest rates. They have to start taking out the liquidity that they had provided to the system. That was the reason why last year, any Tom, Dick and Harry, if they were just buying anything, with all the millennials around and all the anybody and everybody would have made lots of returns. And if they did not, means that they have, they just lost out in the biggest ever growth cycle. But now it's coming back to the reality. Two things are happening broadly. One is that US is trying to take back slowly the $10 trillion they had given to the market. There are ways they do it. Quantitative easing is a classic model. They are slowly taking it back, and they are raising the interest rate. So the cost of capital is going up. The impact it has on the world is the following. Firstly, what's happening is that the stock markets have already started factoring this in. Stock markets are generally the best proxy for where the economy and the world and everything would be in 6 months to 1 year. Stock markets are really forward looking. So about 3 months ago or so, 3 months to 6 months ago, stock markets started reflecting this in their values. So I'm not sure if you are aware. As an example, Zoom, the company that we're using to communicate right now, its valuation market cap was about $20 billion in 2020 March. It went up to close to $200 billion in middle of last year. And today, about a month, 2 to 3 months ago, it's back to 20 billion. So essentially all its value that had gone up and down is because A, COVID is gone, and B, because cost of capital and and the excess liquidity is gone from the system. And this is reflected 30, 50, 70, 80% prices are down for many stocks that had gone through the roof last year. And you can see that in India, you can see that in US, you can see that in cryptos, you can see that in many assets, right? That's clearly reflective. Now, what happens is that VC firms at the end of the day do not have their own money. Sequoia, when they are investing, Accel Ventures, when they are investing, it's not their personal money ever. Generally, they have GPs and LPs, general partners and limited partners, who invest in the fund, and then they use that money to invest into startups. So until last year, when money was pretty much getting distributed almost for free, for the lack of a better word, just as an example, they were spending everywhere. They were putting in there were 40 unicorns out of India last year. I don't personally expect that half of them will even survive in the next 2-3 years. They never had the real business models, and they are constantly dependent on increased funding over the next 2 years, which is not going to happen now. When all this money was coming, this was going to startups. But now what's happening is that these VCs have also realized that their next rounds of fundings are not happening. Their further raise and further milestone driven payments into their VC funds is not going to happen because there is a big liquidity crunch everywhere. So what's starting to happen is the following. One, that VCs are now not just investing everywhere. So the biggest impact we are seeing, and which is again not covered in media anywhere, reality is never covered in media. If you believe in media means you're not really following what's happening. What's happening is now that Series A funding is dramatically choked, and we are seeing it as part of Supermorpheus and many other startups that we've invested in, which were close to Series A sometime late last year. It's already always getting delayed now, and there is likely to be a massive delay on many startups who were looking for a Series A, because VCs are trying to preserve the capital they have, try to make their portfolio of companies where they've already invested survive, make all their portfolio companies go into a model where they're not just burning money, they're not burning 10 million a month or something like that. You've seen Unacademy, you've seen yesterday Vedantu was also laying off people, etc. People are just saying focus on the core business, minimize the burn. We will fund you a little bit, but you have to find a path to bootstrapping / profitability soon, or breaking even yourself. Don't depend upon constant funding. So what's happening is that whichever companies are funded already, they are likely to get some more funding, bridge rounds, that is happening dramatically more. Whichever companies were close to Series A are unlikely to get VC funding now. And many VC funded companies you will see mergers of them happening, because VC can't be burning in one category, let's say making it up, EV or e-commerce or esports, in any category. If they had they were burning through 2 companies or 3 companies, now they'll try to merge them, because they want to minimize the burn. They want to make sure they don't lose money. They don't write off anything. They'll just merge the shares, do a fake valuation of whatever they do, and try to not show a write-off, but just survive as many resources as they can. That's what's happening at the VC front. Now, what we need to do and think about from angel investor or early stage investors perspective is the following, and as startup founders as well. One, find a path to bootstrapping as soon as possible, because surviving right now is not a question of just raising money. It's a question of how you can optimize your costs, focus on the core things. How quickly can you get to a model where you can break even and run the business for 1, 2, 3 years if needed, in case no new funding comes in. That's the worst you have to assume as an entrepreneur. You have to assume that as an investor, you have to assume that as a portfolio company, you have to talk to your entrepreneurs and try to get them into this direction, because that's the only way right now in this funding winter that one can survive. That's the outcome, I think, that's happening. One other outcome that is happening is the following, that wherever VCs are still even putting money in existing companies, down rounds are happening. So as angel investors, we must watch the clauses of down rounds, and in how much time will they do Series A, what's the discount gonna be, what's the cap and floor. All those numbers are gonna become very critical when the down rounds or small bridge rounds and fundings happen. Second thing is also that the valuations will go down dramatically. So at some point in middle of last year, I remember seeing some SaaS companies, the peak multiples they were getting of their revenues or profits were close to 40 times, which is reflective in the stock markets as well. That's what their peer multiples were. But now those 40x multiples have come down to 10 to 15x multiples of the revenue or profit, depending on which sector you're looking at. So the valuations are going down as well for whoever is able to get the funding. So net to sum it up, from very briefly and until we get into more discussions and questions, in my view, the 10 trillion from US was the game changer last year, which nobody necessarily fully anticipated. But to put it in perspective, US has not printed 10 trillion in the last 70 years combined, including all the printing they did in 2009 after the Lehman crisis. They had printed close to $2 or $3 trillion, I believe. Something like that. So this was a massive moment when US printed this money. Everybody just got drunk on the excess liquidity, believed wherever the value is going up is because of their selection, their stuff, their entrepreneurs, their unicorn, this and that. None of it was theirs ever, just like we talk about in spirituality as well. So now, because that money is going away, interest rates are going up, cost of capital is going up, VCs have to choose. They will not do too many new companies. They will do less and less of Series A. And They will try to merge their companies. They will try to make sure they go profitable. Hence, a lot of layoffs in the startup world would happen. Are happening. We've seen like at least half a dozen plus companies reported in public. I know at least dozen plus personally where there have been 50 to 70 to 30% layoffs already. And as an entrepreneur, as an angel investor, we have to check the valuation and the terms as well as we can, including all the CCDs and the time it takes to convert or to raise the next round. And lastly, move to bootstrap as soon as one can. If you cannot get to a bootstrap, and if your business depends upon constantly burning money or in order to build the market, build the users, this is going to be a very, very hard time this year and possibly longer. VC funds are typically raised to be deployed over 2 to 3 years and up to 7 to run the portfolio, 7 to 10. They raised, many VCs raised additional funds last year. So they're still liquid. And while they may not be investing in newer companies, but in the existing ones to keep them running, they are doing the subsequent rounds more. So it's getting more concentrated into a bunch of companies. That's one. Funds were already raised by them to a large extent last year, which was a good time to raise funds for anyone in the world. But also there is always a lag into these things. So if you remember in 2008 crisis, in 2006 or 7, the Bear Stearns fund went down, but the whole stocks of Lehman and other companies that survived were still high, and everything was high until middle of 2008 when everything started crashing. So the first signals are there, but it takes typically about a year or so, year plus, for the whole financial services ecosystem, so to say, including the startup funding right now, and possibly the economy to see the effects fully. I guess these are a couple of points I wanted to add when you were saying that there's a lag, and these could be the reasons. And this is the analogy that comes to my mind. 2007 also was a big enough year, but still it was crazy on Wall Street, as you might remember as well. So I think that's a classic human nature thing, that where everyone feels that the next guy is doing the work.
Yeah,
I will take care of it. And not to necessarily take names, but last week Ashneer Grover was in Chandigarh and somebody asked him on the stage, so why did your audit found that there were misappropriations of funds? What happened? And he said, now that I've left the company is when the VC is raising the point. When they were there, they had a quarterly audit. They never checked. He did not defend once that there is no misappropriation.
Yeah.
He was blaming the VC for not doing a proper audit. By the way, the auditor is reporting to the CEO. CEO is paying for it. So generally it would not be found. But again, even VC never did the due diligence in time, so to say. So I think everyone feels that somebody else will be doing it right and somebody will come and save the world and everything would be okay. But that's a big misleading thing. And that's what I was saying in the crypto times as well, that everyone is doing it doesn't make it right. You should figure out what you're doing, why and how. If you just want to follow the crowd, that's okay. But understand, if the crowd goes off the hill, you go off the hill too. But if you want to do, otherwise you ought to do your own due diligence, and just assuming somebody else, Kunal Shah might have done it, Uday might have done it, Samir Guglani might have done it, Mati might have done it, is not good enough. Or if some VC firm has come in, don't assume. That's what happened. This is how all the bubbles are built. Think about 2099 .com one. Think about the credit bubble in 2008. Everyone feels somebody else would be taking their job seriously, but reality is most people don't. They end up doing just the bare minimum. I think VC funding is definitely looking sexier, but it's not. In reality, VCs somehow I don't think are the smartest people at all. I think as a founder, for you and for many of us, most of us, I think as a founder, it comes down to what kind of business you are in. You need to know that. You need to understand that. Now, if you're building so look, as an example, a Kirana store is a startup. I could start one today, do very well, make 20% year-on-year returns, be very happy. It's a family business. It works well for decades. It's not that before 2008 in India, no business was ever built. The largest empires, largest businesses of entrepreneurs, listed companies or unlisted ones are very well done, and they are living very happily ever after of sorts, right? So you don't need VC funding to prove anything to you. It comes down to what kind of business you want to build. Now, you may want to build a lifestyle business. You may want to build a business that can scale fast. And to scale fast, you need to know the market landscape, how much you need, when you need, which kind of VCs you need, if you need them at all. Or maybe you can bootstrap it. Zerodha was also bootstrapped in the last 12, 14 years, did very well. Zoho did that. But Freshworks, on the other hand, did not put in 10 years, but spent, because he had seen the full Zoho journey, raised a lot of capital in a couple of years, and then built a fast, much faster, much bigger. It's a different model. Whatever works, there's no right or wrong. But I would highly recommend to every founder ever, never ever take a VC's decision to invest in you or not, or the question they ask or they don't, as any validation of your ability to build, scale a business. It has nothing to do with it. It is the last validation you want, right? So you don't need that validation at all. You believe in it, you go for it. And if you understand, or if you meet enough people, you will eventually figure out what's the right way, what's the right model for you. Forget about VCs. Avoid them as far as you can. I'll try to answer this if I can. Firstly, VCs prefer earlier companies and later. So the reason is that if you raise after 8 years or 10 years, your own entrepreneur's fire in the belly is limited. You've already burnt it out a lot. You will not be able to do what they want, which is in 9 months, the next round, in 18 months, another round, and grow 100% year on year or X%, whatever. So generally, VCs prefer early ones. Number one. Number two, as a general matrix, as a thumb rule, out of 100% people who try to raise from VCs, all the startups and many other people, less than 1% are ever able to raise it. So most likely you'll not be able to raise it. Okay, don't go by what Economic Times tells you. It's just played glorified media. Don't believe what you see. Okay, reality is. Thirdly, I think if you build a good enough business, VC will come to you. That's the best point to raise, when you don't have to go and raise.
Absolutely.
Right? Lastly, even if you have to raise, find ways of raising in which your business has to be sexy enough for the right VC. So there's a lot of background work. If you want to approach a girl and say, I want to take you out for a coffee, it's not a good thing. You have a wingman who knows the girl, who says how cool this guy is, why don't you go out with him? So there has to be a way. There's a way to, there's an art in it. So VC should feel the FOMO. If they don't come to you, they're going to miss out. So you have to create that somehow. Maybe that helps a little. It's a mutest point of the all 4 points I made. That's just an analogy I'm trying to use, because otherwise you are just one of the 100 guys going to a VC every day. They're looking at hundreds of emails, hundreds of introductions, hundreds of pitch decks. And for them, you are just source of content. They're just willing to learn about your space, and they'll say very excited, but this and that, and there are a million excuses. And then those MBA kids are gonna feel smarter. That's it, nothing else, right? So I hope it helps.